Why do taxes come into the discussion if we're talking about inventory costing methods for financial reporting? In this video, I will talk about the GAAP tax LIFO conformity and about the disclosure that LIFO firms must make about the LIFO reserve. In the prior video, I introduced the calculations of the inventory costing methodologies LIFO, FIFO, and weighted average. And where we ended the prior video is in the summary of what we expect to see if the company has elected one of these methodologies for their inventory costing. When inventory unit costs are increasing, when the firm is in the inflationary period, then FIFO gives us the highest balance of the asset inventory on the balance sheet, the lowest cost of goods sold, the expense, and correspondingly the highest gross profit on the income statement. LIFO, on the other hand, will give us the lowest asset on the balance sheet, the highest expense on the income statement, and the lowest profitability. Weighted average is always going to fall somewhere between the two. Now, in the periods where we have actually a deflationary period instead of the inflationary one, the effects are going to be reversed. FIFO will give the higher expense on the income statement and correspondingly the lowest gross profit. LIFO will give the lowest expense and the higher gross profit, and weighted average will fall somewhere in the middle. And this is important for us to keep in mind because if we are comparing a firm that follows the LIFO methodology and the firm that follows the FIFO methodology, even if they are in the same industry, then potentially we're going to have an incomparability in terms of their financial statements being impacted not only by the underlying economic events, but just by the choice of accounting that they've done. And in this video, one of the things that we will learn is how to make the adjustment and to convert a LIFO firm to make it comparable to its FIFO peers. But first, let's talk about why we have firms that might be electing to follow one methodology or another methodology. And interestingly enough, we have to introduce here a discussion of taxes. Now, normally on this channel, we're not really going to talk about taxes at all. And that's because financial reporting and tax reporting tends to be very, very different. For most of the accounting items, the financial reporting, the GAAP reporting is not going to be aligned with the tax reporting. And that goes for everything from the specific nuances of revenue recognition to depreciation expense calculation to bad debt expense, etc. But we do have an exception here in terms of the two regimes, the GAAP regime and the tax regime talking to each other, and that's specifically in the choice of the inventory costing methodology. If you use LIFO for your tax reporting, you must use LIFO for your financial reporting as well. Now, why might you want to use LIFO for your tax reporting? Remember what we saw on the prior slide. LIFO leads to higher expense and lower profitability in inflationary periods. And since most firms over a long span are in a situation where on average their inventory input costs are going up over time, LIFO will be a little bit more tax friendly in terms of lowering the current period's taxable income and deferring some of those taxes to the future period. However, you do have this dynamic that because of this tie, because of this conformity, if you choose LIFO for tax reporting, you will show the same lowered income on your income statement as well. So inherently, we have this tension between showing higher income on the income statement and minimizes taxing and optimizing cash flow from that perspective. FIFO reports the higher income, but also leads to higher taxes if prices are rising. LIFO reports the lower income, but also gives greater tax saving if prices are rising. Again, on the last slide of this video, I will talk a little bit more of the advantages and disadvantages of LIFO versus FIFO. One thing that we should note is LIFO is not allowed under the international rules. Any company that follows the international financial reporting standards, but they could be trading in the United States and filing with the US regulators, they will not be using LIFO because that is only allowed under the US GAAP, but not under IFRS. So how common are actually these methodologies? I don't have the most recent numbers. This is a survey that's a little bit out of date from 2013, but it is, I think, representative of the fact that all of these methodologies can be found among the largest firms in the United States. They can be found among publicly traded pool of firms in general. So from this survey of the 500 largest firms, we see that 62% of firms use FIFO, 33% of firms use LIFO, 27 use weighted average, and 12 use another methodology, which are less common. A lot of them are industry specific, which I'm not really going to cover in my videos for now. Now, if you are astutely looking at the slide, you might notice that the sum actually is greater than 100, and that's because the firms are allowed to use more than one methodology for different pools of inventory. This comes about pretty common as a result of a merger. So if you have two companies, one was a LIFO firm, one was a FIFO firm, when they merged, but perhaps they continue to operate the newly combined firm as two distinct business units, they might elect to still keep the two methodologies. Even in the absence of a merger, you might have a firm which has two very distinct divisions, two different types of inventory, maybe with different input price volatilities, and it makes sense for them to follow the different methodologies. So that is perfectly acceptable. You could have firms which are electing multiple methodologies for various types of inventory. However, the regulators do have the expectation that the costing method is consistent from period to period. So once you have elected into the methodology, you are locked into it. Is it possible to change? Yes, but there are a bit of hoops to jump through. So the change needs to be justified. So you need to have an economic reason or an operational changes that you're going through. It needs to be approved. So just signed off by the auditor, by the taxing authorities, and it also needs to be disclosed. Here's an example of disclosure from 2019, Timken Steel. They elected to change the methodology for inventories. Previously, they used the LIFO method, and now they're changing to the FIFO method. They talk about the fact that not all of their inventories, but a big percentage, so 70%, were on LIFO. And they give us a brief sense of why they're switching. The company believes that the FIFO method is preferable. It improves comparability with peers, more closely resembles the physical flow of the inventory, and aligns with how the company manages their business. Does the choice of the inventory costing methodology always matter? It doesn't matter if you are in a situation where your inventory input prices really don't change over time. So if you have low inflation or deflation, if the inventory pricing is just fairly steady over time, then the methodologies are really going to give you very similar number. There's not going to be a material difference. So it kind of doesn't have a strong impact. Same thing if you have a very fast rate of inventory turnover. If you just buy a lot of inventory, and even if you have inflation or deflation, but you also sell majority of that inventory within the same period, so you don't have a significant kind of carryover, there's going to be a difference between the methodologies, but it's not going to be material enough that maybe it is very significant. But for plenty of industries, for plenty of companies, they both have a fair amount of input price variability over time, and the rate of inventory turnover is not so high that it doesn't make a difference. We do see definitely trends in terms of the history of the application. This is a screenshot from a very, very old journal, the Tax Advisor from 1975, that was highlighted that a huge number of firms were switching into the LIFO methodology. So of the biggest firms, just in that single year alone, 150 corporations were changing to LIFO in 1974. And that's because if you go back to history, what was happening in 1974 is double digits inflation. Now, in the more recent years, what we have seen is that the choice doesn't matter dramatically. So here I took the data from the past several years, and I calculated what is actually the median size of the LIFO impact on inventory value. So if you have a firm and it is a LIFO firm and they do disclose how they would have looked like a FIFO firm, so kind of what's the impact of how their asset would have been if they were a FIFO firm, we see a pretty significant difference in terms of the mean, 15 to 20% of the asset value on the balance sheet would have been different. In terms of the median, still, their asset value would have been different by 10%. That's not insignificant. But in the past 10 years, that have been going down over time. And that's because we kind of had a fairly stable input prices. A lot of companies have also improved their supply chain dynamics in terms of the inventory turnover being a little bit higher than it was previously. Overall, we both see firms in the more recent past, like Timken Steel that we saw in the prior slide, switching from LIFO into FIFO, and then the firms who are still on LIFO there's not as much of a difference in terms of the materiality of the impact of that choice. If you are a LIFO firm, you have additional disclosures, and those are to enable the investors and other users of the financial statements to improve comparability. Firms are required to disclose which methodology they use, and LIFO firms have to disclose what is the impact of using LIFO. That's the disclosure that I used to create the chart on the prior slide. This is what the disclosure looks like. This is from United States Steel. It says the LIFO method of inventory was used on 53% of inventories. The replacement cost of the LIFO inventory was higher by approximately $1.1 billion. So what they're really saying is on the balance sheet, they have inventories which are $2.168 billion. If they were not using LIFO, if they were using FIFO, then this number would be $1.1 billion higher. So in the case of United Steels, that's actually a really big impact. Here's another example. Kroger, the supermarket, which I find it really funny that they actually use LIFO, because if you think about any company that has the incentive to follow FIFO in terms of their physical goods, of course, it is somebody who deals with highly perishable items like supermarkets. But like we said before, just because you follow physical flow of goods under FIFO doesn't mean that your accounting assumption has to match. And they do have inventories that they carry on the LIFO basis, and their disclosure is a little bit different. They use the word LIFO reserve, which is what I'm going to use in these slides as well. And they say that the LIFO reserve as of February 1st, 2025 was $2.4 billion. So the inventories that they would have reported if they were a FIFO firm are $9.4 billion. But because they are a LIFO firm, on the balance sheet, they actually report something that's closer to $7 billion because of this adjustment LIFO reserve. Now, United States Steel Corporation didn't use the term LIFO reserve. They just had kind of a qualitative discussion of this item, but this $1.143 billion, that's their LIFO reserve. Here's another example of a company that does use LIFO, which is Macy's, but they tell us that the value of the inventories under LIFO approximated the cost of such inventories under FIFO. So essentially they're saying the LIFO reserve is zero. The value that we would have reported if we were a FIFO company is materially the same. It doesn't mean that it's literally zero, but it means in terms of the materiality of the financial statements, it's approximately the same. We can use this reporting to adjust a LIFO firm to look like it would have done if it was a FIFO firm. And we want to do that because if we want to make a comparison based on the balance sheet numbers, based on the income statement numbers, we need to make sure that we're doing it apples to apples. We are going to rely on this LIFO reserve number that they disclose. This reserve represents the cumulative effect in all of the years that this company has used LIFO on their cost of goods sold, on their gross profit over time. Now, we're also going to be able to calculate the change in the LIFO reserve because they will give us this number from the prior year and from this year, and that change in the LIFO reserve will represent the effect that using LIFO has just on the income statement this period. The formula that we will use adjusting from LIFO to FIFO is if we want to adjust the balance sheet, if we want to adjust the asset inventory, we're going to use the full amount of the LIFO reserve. So we will start with the value of the inventory that the company actually reports, and we will add the full amount of the LIFO reserve. Now, if we're adjusting our income statement numbers, we will start with the numbers that the company actually reports in the income statement, and we will adjust it by the delta, the change in the LIFO reserve. So this little triangle is a Greek letter delta, and mathematically, we just use it as a notation for change, any change. In this situation, delta LIFO reserve means this is a change in the LIFO reserve from last year to this year. For the cost of goods sold, we will start with the cost of goods sold that the company reports, and we will subtract out the change in the LIFO reserve. Correspondingly, the calculation of the adjustment to their income, whether we're using gross income, operating, any pre-tax income, is going to be the addition of the change in the LIFO reserve. If we're adjusting the net income, the post-tax number, it's a little bit more complicated because we then need to know the tax rate, and we will adjust by the delta, the change in the LIFO reserve, times 1 minus the tax rate. Keep attention to the sign, to the delta. If you have LIFO reserve that grows from period to period, then the change is going to be positive, but it is possible to have some years where the delta is negative, where the change in the LIFO reserve is decreasing. And in this case, this is going to be minus a negative number, which of course turns into a positive. And in this case, it's going to be plus a negative number, which of course is a subtraction. Let's put some real numbers because it's probably a little vague at this point. These are disclosures from Chevron. And this is from 2022. This is the balance at the end of the year. The inventories that they reported on the balance sheet were $8.2 billion and $6.3 billion, respectively. And Chevron is a LIFO firm. It values a big chunk of their inventories on LIFO. So in the footnotes, they give us the LIFO reserve, which are really big numbers, $9 billion in 2022 and $5.5 billion in 2021. I also pulled from their income statement that their pre-tax income for 2022 was $49.6 billion. And let's suppose we're comparing Chevron to a European firm that does not use LIFO, that only uses the FIFO, and we want to make it apples to apples. So we need to convert to how Chevron would have looked like if they were a FIFO firm in 2022. For the ending inventory, if we're doing something like inventory turnover ratio, right? And we need the balance sheet number of the asset inventory, how it would have looked like under FIFO. We adjust by the full amount of the LIFO reserve. We start with the inventories that they did report, 8247. We add the LIFO reserve, 9061, and we say if they were a FIFO firm, they would actually be reporting inventories, the asset of 17,308. Now, let's suppose we want to do some income statement comparison. We want to do a pre-tax income margin comparison. In this case, we need to convert their LIFO-based pre-tax income to how it would have looked like as a FIFO-based pre-tax income. We're going to calculate the change in the reserve. So in this year, the reserve grew by a large number, by $3.4 billion. And then we're going to follow the formulas from the prior slide, and we say we start with the pre-tax number that they did report, and then we add the delta, we add the change in the LIFO reserve, so plus 3473. So they reported profitability of $49.6 billion, but if they were a FIFO firm in 2022, they would have reported profitability of $53 billion. How did Chevron save on taxes as a result of using LIFO? And notice that I have save on in quotations here because really this is a deferral of the tax payment to some future period. In 2022, they have depressed their income by $3.473 billion as a result of using LIFO. So if we assume some 20% stable tax rate, then they will have saved $694 million, which again is just the 20% tax rate times the change in the LIFO reserve. Now, how much do they defer overall in all of the years of using LIFO? Even though this is only the data from 2022 and 2021, we can think of the final balance in the LIFO reserve as made up of many, many deltas, right? It kind of grew over the entire history of them using LIFO. So in terms of the total impact, if we apply the same 20% tax rate to the full balance of the LIFO reserve, then we have a total deferral of taxes of $1.8 billion. Of course, this is a simplification. The tax rates don't remain stable over time, so this is for illustration purposes only. Like I mentioned before, the LIFO reserve doesn't actually always increase from period to period. So if we're sticking with Chevron, and if we look at all of the years of them using LIFO, all of the ones which are highlighted in yellow are the ones which are like 2022. We see the LIFO reserve increase over time, and those are the years where using LIFO essentially increased your cost of goods sold and depressed your taxable income. But all of the years which are in pink are all of the years that the LIFO reserve went down from period to period. And again, keep in mind that that's because for somebody like Chevron, where the input prices are based on the oil prices, you have inflationary periods, but you also do have deflationary periods. You have a lot of volatility. And all of the years which are in pink are all of the years where using LIFO actually decreased the cost of goods sold and therefore increased taxable income. Finally, let's finish with a big picture slide of LIFO versus FIFO. What are some of the advantages and disadvantages? Can we say that one is better than the other? And if you watched my other videos, you know that that's probably a trick question. Very rarely in financial reporting can we make this unequivocal statement without further information. And that's the same thing here. There are certain advantages to using LIFO. In inflationary periods, using LIFO will lead to higher cash flows because you do have tax savings in that period. Very important also, something that a lot of people don't really think about, but LIFO actually does a good job in terms of presenting our income statement more accurately. Why? Well, because the sale prices on the income statement, the revenues, are based on the most recent sales, right? They're based on the sale prices that the company have elected for this year. And under LIFO, the cost of goods sold is also going to be based on the most recent purchase prices. So LIFO does a good job in terms of matching the most recent costs with the most recent of sales you're able to generate. So it actually gives us more accurate profit margin understanding of the company. There is also lower likelihood of inventory write-downs. I will talk about inventory impairments in one of the future videos. Under LIFO, you have lower carrying value of the asset inventory on the balance sheet, and that just means there's going to be less probability of needing to do an impairment. However, there are some advantages to using FIFO. Number one, in inflationary periods, will give a higher reported earnings. It will, for most firms, be better aligned with how they actually flow their goods throughout their businesses. The inventory and the working capital numbers on the balance sheet will be more closely related to the actual replacement cost. They won't really be outdated. They will be an accurate picture of those items. It is simpler record keeping and lower disclosure. This additional disclosure requirement that we talked about, the LIFO reserve, that only applies to LIFO firms. So FIFO firms, a lot less administrative hassle from the accounting side. And lastly, because the US GAAP allows LIFO, but the IFRS doesn't, there is better comparability to the international firms if you are a FIFO firm. That was a discussion of some more nuances of LIFO and FIFO reporting and how to adjust a LIFO firm to how it would have looked like as a FIFO firm. I hope that you enjoyed this video. If you did, then please subscribe. Leave me a comment in terms of the topics or questions you'd like me to address in the future. Give it a like and share it with your colleagues and friends. I'll see you in the next one.